the Western week and through the midweek in the Middle East. Thank you for joining us. Again, a week of not too much movement on oil prices, despite the fact that we're still waiting to hear from OPEC Plus on any resolution to their spat, I suppose everyone is describing it 10 days ago. Not too much movement. Bora, if I'll go to you first, Bora Bariman, managing partner at Hormuz Straits Partnership. Despite the fact that we haven't really heard anything from Saudi or UAE, at least officially, or OPEC in the last week or so, not too much movement in prices. We saw them drop yesterday, we see them up this morning on different factors, but not really moving on the back of this impasse. Would you agree that that's the case?
You're right. I think it seems that the recent oil price dynamics have been tentative, and the market is looking at these complex countercurrents and deciding to sort of stay in a holding pattern. It's very difficult to say whether we are going to have a sort of ramp up in demand as would be indicated by the continued easy money and liquidity going in the markets, or some type of slowdown driven by the spread of the variants around the world. And of course, we see that there is a pressure to put more product into the markets, both by certain members of the OPEC Plus group and also in the US, where there is more investment going into the shale patch, for example.
Yeah, we see, I mean, you mentioned shale there, and so let's talk about that a bit. Obviously, we've seen, the market has been waiting for shale to recover with the rise in prices in the last few months, and yet it's been holding back for the various reasons that have been discussed over the months, which is financial pressure from their shareholders, making sure that they can meet their dividends, reducing costs, etc., and that OPEC's got plenty of oil there to control when extra supply is needed. But we are seeing a momentum now with shale. We've got an article up on our news bulletin today saying, where it's reached at the moment, up to 7.9, I think, million barrels a day, and it's on its way up, finally sort of breaking through that. And yet, where is that, Bora, in terms of that versus the hedging they've done, where they've made some losses? Are we actually going to see that momentum continue now that we're into the second half of the year?
Well, really, in my opinion, if we don't see some serious investment going into the shale patch now, we might never see it, because it's a perfect, let's say, alignment backing up the case for shale. You've got a relatively high oil price now. You've got relatively loose credit in the US, especially. You've got American banks looking to earn that fee income, driving mergers and acquisitions across the major industrial sectors, and certainly the energy patch would be one of those. But of course, there's that uncertainty about the energy transition that may be holding back the investment case and the participation of certain lenders. So I think, in my opinion, this is the perfect moment if you're going to dive into investing into shale in the US. This is the moment to do it. And if you're uncertain now, perhaps you'll never get comfortable with it.
Thanks, Bora. Edward Bell, Senior Director of Market Economics at Emirates NBD. Welcome again this morning. Ed, on that point of shale and investment, we've got another article again up on our bulletin about US mergers amongst energy companies and how that's getting a little bit of an impetus and a bit of a push with the uptick, I suppose, in the industry, in the sector this first half of the year. But on that point, we keep hearing about, the energy transition's coming, so no one's going to invest in shale anymore. Putting that aside, that's a medium to long-term thing. We still see oil and gas companies producing oil. So your opinion on that, on the shale front, from a financial point of view, from the restrictions that are being put on those companies, are they still holding back, or is it just too good to be true? We're nearly at $80. Forecasts are that maybe we've peaked, but that's a pretty steady price. Where are you on that?
Yeah, I think the conditions that we see in the oil market, as Bora mentioned, are kind of quite optimized for shale right now. That you have the space to increase production, and not only that, it's at a time when prices are quite high. You know, when we've looked at different surveys from Federal Reserves in the United States, particularly the ones in Texas, they usually kind of point to capex break-even costs in the sort of mid to low $50 barrel kind of range. So with the WTI curve at $70 plus, at least for the next 6 months or so, that's a certainly very attractive opportunity, I think, for shale producers to come in. But as you say, there's been this reticence to go for volume over value in this current cycle. And while we have seen a recovery in the rigs being added back into the market from their trough level in around about a year, in August of last year, we're not seeing a real material change in terms of volume. So US production has basically been flat at around 11 million barrels a day since then. There was an interesting report out recently as well, though, from the Kansas City Fed, which I think made for some interesting reading, where they surveyed oil and gas exploration and production companies in the US on their outlook for prices. And 5 years down the road from now, they still only expect to see prices in nominal terms at around $78 a barrel. So that's not an enormous increase in nominal terms from where we are at the moment. So it is suggesting that there might be some more ingrained reluctance to make these kind of long-term capital investment plans if the outlook for oil products or for oil production and prices in a kind of a medium-term outlook for a lot of these companies is not that inviting.
And I mean, would you agree with a bit of opinion that we've had this week on the show earlier this week, that we are now reaching finally the latest of peak in prices, if you like, having seen the run up that we've had over the last few months? Would you say this $80 mark that we're heading towards is the turning point, is the ceiling?
I think, it's a really difficult one to say that $80 would be the upside limit, because as you say, we're in this kind of, we've been describing it as this unofficial blackout period, similar to what you would have from the Federal Reserve or in a central bank. So we're dealing with that with OPEC plus right now, as nobody knows what they're going to decide. We've got Eid next week, so that's probably going to push any decision on production levels further back. So the risk is that the market doesn't know what's going to be happening in terms of production. You could see prices easily touch $80 a barrel, and I don't see why you wouldn't, in that context, go much higher if the market attention and focus was firmly on the supply side of the issue. But in a way, thankfully for importers or for consumers, there is also this mounting anxiety around the spread of variants of COVID-19, more countries needing to impose mobility restrictions or lockdown measures. And so that's helping to keep us in this kind of precarious balance of sort of $70 to $80 at the moment.
Vitaly Yermakov, Senior Research Fellow at the Oxford Institute for Energy Studies. Welcome again this morning. Just to touch on that point of shale versus OPEC, and start with the OPEC plus story with you and Russia as well, the angle of Russia. We've, ever since last week, we even heard talk that Russia now is going to sort of mediate between Saudi and the UAE to try and kind of keep the partnership going and in check going forward. What's your opinion on that? We haven't really heard anything. You could argue that it has exceeded people's expectation, that this impasse has lasted longer than people expected a week ago. Why would OPEC plus keep the market guessing? We're going now on Eid, as Edward just mentioned, in the Gulf, in the Islamic world. We've got a bit of a pause in the news cycle perhaps next week. Is it healthy for the market that OPEC plus is keeping everyone guessing? What does it really matter?
Well, thanks, Diala. Good question. Everybody expected that Saudi Arabia and Russia would find it difficult to cooperate in the rising oil price environment, but it turned out that it's Saudi Arabia and United Emirates that would find it difficult to find a compromise here. So surprise, surprise. But I guess the impasse is quite convenient for everyone, so long as prices are rising, and they are. And so for OPEC plus, I think it's a very convenient indecision, and they are making money on the price increases, not on the volume increases for now. And especially given the slow reaction from US shale, they are not worried in the short term about losing their market share. So again, it's from every point of view, it's extremely convenient. How long the situation can last, of course, that's the key question. And everyone is looking at shale. Everybody is wondering why the response is slow. Well, just a hypothesis here. I think we should be mindful of the difference between the observed prices in the market and the realized prices for shale producers. And what I mean by that is that if some of those producers, especially those who had to hedge because of the requirements by the banks, by the financial institutions, locked themselves into $50 oil, they have not seen any of those upside price-wise. And I'm not saying that most of shale producers have done that, but I guess some had done that. Obviously, big players like Exxon, they never hedge. They have natural hedge in the form of their refining assets. But for those players, the story is probably different. And there's so much pressure on large vertically integrated oil companies, international oil companies, coming from the energy transition agenda. That might give them a pause.
We have, nevertheless, we've seen, and we just had a comment there by Rustin Edwards saying shale has gone up 500,000 barrels a day in just 2 weeks. So some producers are okay. They may have hedged the wrong way, but they're still managing to sort of increase their production and put the money in there. But Vitaly, would you say that what's really holding shale back is OPEC policy rather than their own sort of economic realities? So i.e. the fear or the power now that OPEC really has on the market with its excess capacity and supply and the mechanisms that it's set up to be able to obviously manage the market so well as we've seen. Is that really what's holding shale back?
Well, in fact, I think that the miracle in US oil fields, it's sort of, it has gone beyond all expectations. And I think we have seen a real cargo cult emerging. Just so many people are thinking that this is forever. This is going to last forever. And in fact, there are strong economic reasons to believe that shale might turn out to be this short-term phenomenon in terms of very fast pace of production increases. It's only in 2020 that shale producers as a group managed to produce positive cash flow. For 10 years prior, the cash flows for them were mostly negative. And so they burned tremendous amount of money, produced significant volumes, but in terms of returns for the investors, that has been a very sad story. Only in 2020, they managed to return back to profitability. And I guess investors now, they would expect these companies to be profitable before they can provide this robust growth. So profitability first, growth second.
Thanks, Vitaly. Bora, we just put up a survey question there that we did this week, which was let's switch now. We're talking about supply, and I did want to touch on Iran a little bit, but let's get off supply and go on to demand and look at that side of the equation. We had a survey result there saying 70% of our audience felt that this worry about COVID-19 infection rates, it continues to sort of be a little bit of a burden, obviously, on the demand picture and exercising caution on where demand will be going in the second half of this year. Bora, and looking at emerging markets in particular, where we're seeing the COVID story hit much stronger now in the second half of the year. We see Europe and the US recovering to an extent, but really emerging markets from South America to Asia really still in a very uncertain territory there on where the infection rates are going to go and therefore growth. And that includes China, of course, as well, where we've seen a drop in oil imports in the first half of the year. Where do you see the trend for demand growth in emerging markets going in the second half of this year? It looked more positive, arguably, until the end of June.
I'm going to state my personal opinion that things will be improving in terms of Asian demand. Now, there are reasons to argue against that. Yes, the Delta variant will be spreading, and as it has spread rapidly in Europe, but we see that oil demand is increasing simultaneously. It depends on the policy reaction to this growth in the spread of the Delta variant. In Holland, where we had an opening about a month ago, infections have spiked, and the prime minister has apologized that he took that decision to open up the economy. But at the same time, there were no real increase in hospitalizations. It was spreading among young people who were relatively healthy and who could just sort of recover within a week. Now, and what you see in the UK is you have a liberalization. Again, the variant is spreading, but the deaths and the hospitalizations are relatively low due to the vaccination part of the equation. So the question in my mind for the Asian economies is how effective will their vaccination campaigns be? And if they can be effective, I do believe they will be able to keep their economies open relatively in terms of transport, right? People moving around and consuming fuel. But if the vaccination campaign is not targeted effectively to the groups at risk, yes, some more drastic measures may be required. But again, personally, I'm of the opinion that we've got this sort of harsh lockdown periods in the past, unless a new, more deadly variant emerges. But at the moment, we see that this Delta variant is not, let's say, harsher in its effect on human health. However, it is slightly more effective in spreading.
It's hard to tell really in Asia, because you haven't had such a successful vaccination campaign. So you've got Europe and the US where you've had the vaccination take effect, and in Asia not so much. So to judge where that's coming from, I'll just put up the survey question for today for everyone to look at, which is on the question of Asian demand, China oil imports. If we can put that up, please, Stephanie. There you go. China Customs reported first half crude oil imports falling 3%. That's not a new stat. We've seen that statistic sort of in the last few weeks, that Chinese imports have dropped. There's various reasons for that. Ed, we have that question for our audience. Will that trend continue in the second half? We'll have a look at what people come back with there. Ed, just to go to you on the demand picture and how much financial policy, I suppose, being set from the US is affecting that going forward in the second half of the year. We've seen the sort of worry on inflation arguably kind of dissipate a little bit over the last 2-3 weeks, having seen the sort of the panic and the effect on bond markets and etc. And the Fed sort of giving its medium-term outlook. I know we're expecting a bit more news this week, but where do we stand there? Would you agree that that has just dissipated a little bit, the panic of where we're going with inflation, and what do you expect in the coming week from the Fed in terms of any more clarity on that?
Yeah, I think there's a couple of things that have been happening as far as rates market goes in response to the Fed. One is that there is an acceptance that I think on part of it, there's an acceptance in the Fed's view that we are in this transitory inflation period, that yes, we are reopening the economy. We had a really unprecedented kind of economic shock last year. So supply chain disruptions and higher prices when things reopen is going to be natural, but things will start to dissipate. And I think that's been borne out. We've seen a couple months ago, everyone was shocked at the price of building materials, price of lumber, and now they've basically come down to being flat since the start of the year after erasing most of those gains. I think there's also an acceptance that even if we did get inflation rising considerably, we're expecting US inflation later today to come in at around 5%. So if we had levels like that sticking around, the Fed and other central banks have the tools to be able to deal with it. Remember, we are at the lowest bound in terms of central bank policies at the moment. There's other things that they could do in terms of pulling back on their asset purchases or firming up their expectations for growth or for the outlook for rates. So we have basically the full toolkit to be able to deal with higher inflation if it does come. But I think the commentary that we've been seeing, at least from Fed and central bank leadership, is not, we're kind of at pains to not describe it necessarily as hawkish. Hawkish is one where I would describe it as you have a real inflation anxiety or a real inflation problem and you're trying to choke that off. I don't think we're at that stage. We're at one where the Fed wants to get rates back up in a couple of years to maybe at most 1%, 1.5%. In line with a natural recovery in the economy. You know, having rates moving up from zero is not a negative thing. That needs to be happening in line with improving growth over the long haul in an economy. So we want to see that happening. But for now, we still expect to see quite a lot of, not maybe over outright dovishness, but patience and cautious optimism being the words that we would see from central banks for the next couple of weeks. The ECB is the next one on tap next week. We'll be watching them quite closely.
I was going to ask you how much is Europe essentially tracking what the US is doing, or will it go its independent route, you like, possibly?
Yeah, obviously there are independent dynamics to the Eurozone economy that's going to affect their own inflation trajectory over the longer run. But we've seen a policy adjustment from the ECB, very similar to what we saw introduced by the Fed last year. So trying to target a more explicit level of inflation at 2%. Whether or not they'll get there, I think that's a big challenge given the kind of demographic and productivity issues you have across the Eurozone. But nevertheless, it's a bit more explicit. And I think that's what the market wanted.
Okay, and what about my question on emerging markets, Ed, before we leave you, in terms of, you know, where those are going? We've talked about the COVID policy, if you like, there, and we've seen South America, we're seeing riots there in Cuba this week as well, in Latin America, not just because of COVID, just because of the economic management of everything, but COVID has compounded that all. Where do you see that going? I mean, is emerging markets trailing far behind Western economies in terms of how they're recovering? Is that going to impact Fed policy at all? Do they care, or will they just sort of focus on their domestic agenda?
No, I think the overwhelming focus for the Fed does remain the issues in the United States. There will, of course, be awareness of the ripple-through impact of US dollar policy around the world, not least, you know, here in the Gulf region, we basically imported wholesale. But I think the outlook for emerging markets, not entirely, but for some of them that are more exposed, is not very promising right now. As you say, we've had vaccination campaigns that have not had the same amount of momentum that we've seen in developed markets. You have markets signaling that they are accepting in a couple of years' time, at least, that US dollar rates could be going higher, and that could be accompanied by a stronger dollar. And you also have most commodity prices at quite elevated levels. So if you're not an oil exporter, you're not a copper exporter, this is going to be a pretty tough time to be facing all of those financial challenges at a time when you're still dealing with a pretty severe public health emergency in most of these countries. So we are a little bit cautious on the outlook for most emerging markets in the second half of this year, at least.
Vitaly, we haven't heard much from Russia in terms of how the COVID situation is impacting, is being handled. It seems that everything's going okay. Obviously, Russia's not necessarily an emerging market, but I mean, how is that being absorbed? And also another comment from you, please, on where Russia's perspective here today is on the oil price. You know, it's been tempering, saying that it wants to protect its market share, it wants to bring back production. It's not as concerned about oil prices as the Gulf producers. Where does Russia stand today on that front in terms of how its economy is doing from a COVID perspective, and any pressure it's going to put on OPEC to really start to release more oil than is indicated?
Mm-hmm. Well, we have seen some increase in COVID diseases and lots of new deaths, unfortunately. And
but is it impacting
I think this really had to do with the fact that Russia really opened up its economy and allowed international travel, and so the results were unfortunately the increase of COVID rate recently, especially in Moscow. Still, Russia, I think, and this was basically the decision supported by the majority of the population. Russia didn't go for a new lockdown because people got extremely tired of that, and these measures would be unpopular. And instead, there was this call for higher vaccinations and really trying to make people vaccinate by offering them different kinds of prizes and lotteries, or introducing some requirements that would sort of make them want to vaccinate, because sort of if you are not vaccinated, for example, you cannot go to a cafe or restaurant in Moscow starting from August 1st. You need a special code certifying that you've been vaccinated. So I think this combination of measures would...
Yeah, in terms of its economic recovery, I mean, now looking to
that's what I'm saying. It's COVID is not a danger to the economy so long as the economy keeps functioning, and the economic outlook for this year, in fact, has been quite bright. Recently, the Ministry of Economy, Russia's Ministry of the Economy, increased its GDP outlook for this year, and I think they are talking about a possibility of 5% GDP growth in spite of all these restrictions. And Russia, of course, is benefiting from this increase in oil and gas prices. And I would like to react to some of the comments made in the chat, because there were comments related to the situation in the gas markets and to Nord Stream. Well, we are talking about this tightness in the oil market, and this is obviously a good factor for oil exporters. But there's tremendous tightness in the gas market as well, in LNG market, global LNG market, and this is primarily due to a significant increase of LNG imports by Asia, by China specifically. This loud sucking sound we hear in Europe of LNG cargoes leaving for Asia, it's really it has been quite tremendous. And as a result, natural gas prices in Europe during the summer are over $12 per MBTU. This is quite incredible.
We've had a very strong market. I'd just like to, because we're going to run out of time soon, but strong market for gas in the last 6 months, really. It's been quite consistent. I'll just bring up the survey question answer, please, Stephanie. Oh, there you go. Very tight result. Opinion on crude oil imports into China and demand, really, and the demand indicator in the second half. Bora, just to go back to you on that point, and China, I mean, we had an interview last week with Fujairah, which was telling us how the throughput in the first half of the year volumes was at record highs. Those were looking very healthy, and of course a lot of that product makes its way to China as well. Your opinion, just, I mean, we touched on it earlier, but just to sort of close on this, China for last year was what was holding demand together, really, for the sector and keeping everything going, and was a trigger, you could argue, for prices to start recovering at the end of last year and into this year. And we've seen imports drop, but from a growth perspective and expectations for second half of the year, I'd like to go to you, Bora, and Ed, to close that off. For Chinese growth expectations, the focus has switched to the US as the savior of demand this year, but where are we with China? Bora, first you.
My opinion is that, China is in a pretty good space. Again, you contrast Russian growth. It's driven by materials, commodity. When you look at U.S. and Europe, it's driven by this central bank policy. That's not, and it's also not the case in China. It's not really leveraged, and you've got very strong, let's say, household wealth there that is relatively contained within China, right, due to capital controls. And they're probably getting a bit restless themselves in terms of where can we spend our money and enjoy ourselves. It's human nature, right? They want to get out there, but they're constrained from doing so due to the health measures being implemented. And at the end of the day, it is a matter of the the attitude of the health authorities in terms of opening. But as you see in Europe and the United States, once you allow people to circulate, they will circulate. And from a financial perspective, I think China looks strong. So again, it comes down to where does the virus go? But if the virus can be controlled, China looks strong.
Okay, Ed, I mean, in terms of a global growth forecast for the second half of this year, is it correct to say that the US is leading that?
Well, actually, I think in terms of just headline growth levels, we're actually looking at the Eurozone to be a little bit faster than the United States. Now, that's bearing in mind that we would try and keep the Delta variant under control. I think what we've had a very strong start to the year from the United States, but basically we're kind of, at that 95% of the recovery, and the last 5% to get us back to the pre-pandemic levels is going to take that much longer. So we're seeing that play out, for instance, in things like the employment market, where the data that we're seeing is still pretty good. It's just not amazingly strong. So we're not necessarily worried that things fall off the cliff in terms of the outlook for the United States, but it's going to just stabilize at a slower pace. Whereas the Eurozone, we still see kind of a kind of coiled spring effect, if you would, provided that the health constraints can be managed, the UK as well, and that would allow for a good pop in the second half of the year. Just one other point on China is, I think, even if we did start to see a little bit of a growth stumbling there, China's government had been relatively reticent compared with some of the other big major economies in terms of the kind of support they had been deployed. So whether it's in form of easier monetary policy or more extensive fiscal support, those are still tools that are available to the Chinese government to be able to support growth if they see it happening. But that being said, we just had data out this morning that showed Chinese exports doing far better than expected. So it does look like on its own merits, it's going to be sustaining growth pretty well into the second half of the year.
Yeah, and I suppose everyone's just comparing its growth percentages to the past, which were obviously much higher, but still looking fairly healthy. Thank you very much, gentlemen. We've run out of time. I just want to bring up the survey. We had the answer there earlier, and there wasn't sort of much commentary and much sort of swing on that front. So it looks like the US and China are both supporting it going forward. Ed, you mentioned employment is still sort of recovering in the US, and I suppose arguably as the tapering sort of increases, and as those checks start to recede into people's pockets, perhaps we'll see real employment recover and those figures manifest more. Just to draw everyone's attention to our halftime talk for this week, we have Tony Quinn, CEO of Tank Bank International, which airs tomorrow at 12 o'clock UAE time. Outlook for oil storage in a deeply backwardated market. Of course, we've had a lot of commentary on how incredible that we've had sort of demand in question still this year, and yet we have this backwardated market and a very strong upfront market, and some nice comments there on oil storage by Tony Quinn. So do tune into that. Thank you, gentlemen. We've run out of time very quickly this morning. Thanks for joining us. And we will not be seeing you next week because we're going to be on a break for Eid, but look forward to seeing you after that. So have a good break if you are on Eid holidays next week, and we'll see all of you in a couple of weeks' time. Thanks very much, everyone, for tuning in.
Thank you.
Thank you.
Thanks. Bye-bye.